Hello and welcome back to Win-Win Investor. My name is Bill Bymel, and thank you for subscribing. If you have not already subscribed, please do so. Click subscribe. The Win-Win Investor Network was launched just a few days ago, and I'm really proud of the following that we already have. And for those of you that have decided to join the journey to creating win-win relationships in all of our business and personal dealings. I have some good news that I would like to announce today. We will be interviewing John Dario this week. John Dario is the founder of a company called Condor Capital Corporation. They are one of the 800-pound gorillas, you could say, for the distressed mortgage space. And John, who was a regular on CNBC, Fox Business News, in right around the time of the mortgage meltdown and foreclosure crisis of just over a decade ago. We haven't heard much from John these days since he left Condor, so we're very lucky to have a personal interview, which I will be recording this week and releasing over the course of the next few weeks. So let's jump right into it. This is Season 1, Episode 1, a follow-up to my preamble presented just a few days ago. We're going to try to keep it short. We're going to try to keep these non-interview episodes under 15 minutes long, and we're going to delve into some aspect of business, real estate, or finance. These first several episodes are going to be dedicated to my career as an asset manager in the non-performing loan space, NPLs, otherwise known as distressed mortgages. And I have spent the last 11 years involved in that space, first from a real estate brokerage and consulting perspective, and then as an advisor to private equity funds. And now I am the managing director of a capital company based in New York City, which manages several private equity funds in the mortgage space. I'm going to start from the very basics today and quickly go over the idea and concept of a note in mortgage. And we're going to look at it from your perspective and my perspective as homeowners or owners of real estate. And then we'll look at it from the investor's point of view. And then hopefully I'll leave you with a feel-good story about a gentleman I refer to as Harold Cookies. Everything about this story will be true other than the name Harold Cookies. Let's talk about mortgages. What is a mortgage? A mortgage is the pledge of a security, most often tied to real estate. It's a pledge by the owner of that real estate that you are going to repay some debt that will be tied as a lien to that real estate asset, otherwise known as the collateral that is supporting the debt or the loan that we're giving this person. This is very useful. It has allowed millions and millions of Americans to own their homes by going out and buying real estate, pledging the real estate as the collateral, putting a down payment, and then making payments over the course of time. And that's why historically mortgage rates in the United States of America have been relatively affordable as opposed to other types of debt. Credit card debt is often 10, 15, 20, 25% interest rates on credit card debt. Student loans that are not government subsidized are always higher single-digit rates in the 7 to 10 range. And then there's everything in between. There's hard money loans, 12 to 16% hard money loans that are tied to real estate but are not underwritten. And so the idea of a 30-year fixed-rate mortgage, which has enabled so many people in this country to own their homes or to pull cash out of their homes, is also based from the investor's point of view. The reason you're willing to give a lower interest rate as an investor or as a lender, let's say we're the bank, for instance, is because of the pledge of that underlying collateral. In real estate, it's one of the few asset classes where where the underlying collateral value is increasing, if not staying level, over the course of history of ownership. It's the opposite of auto loans. When we take a loan out on an auto, usually the interest rate on that is a little bit higher, and the automobile itself is a depreciating asset. Same with boats, same with RVs, same with mobile homes. These are all depreciating assets that are decreasing in value. And why is this important? Because if you're the lender, you want to know that at least your initial loan is secure. And historically, this has been true because, like I said, real estate's gone up in value or held its value over the long term. The note is the actual debt itself. So we refer to non-performing loans as the note business. It's because we're buying debt. The debt itself that we're buying is a piece of paper that has terms on it, how much is owed, when it starts, when it ends, what the interest rate is, whether there's any other penalties, what I can do to preserve that note. And that note then gets tied in writing to that mortgage, and that mortgage is recorded as a lien against the property. Now, I only invest in first lien mortgages, and that means it's first lien means I'm first in position to have my initial loan preserved because I'm in the first position against the underlying collateral asset. So from an investor's standpoint, you can see why this is usually a safe investment. From a homeowner's standpoint, it's the opportunity to create wealth for yourself. And for many, many Americans, owning their home, the equity, the value, untapped value in their home above that which is owed on their mortgage is most Americans' largest single investment, and it's a security and ability. It provides an ability for retirement or as an income gain, wealth builder for the future. Everything kind of got thrown on its head in 2008 because all of a sudden, for the first time, there was a confluence of predatory lending, crazy mortgages being given to people that didn't deserve it, overpriced real estate, and then the failure of many investment banks and the subsequent default before and after that of millions of these mortgage loans that were given. And so for the first time, real estate dipped below value of the underlying debt that was on many of these properties. This, from a homeowner's standpoint, was obviously a very harrowing time. I will tell you the story of Harold Cookies. Harold Cookies I met in 2014 when I asked the judge in our foreclosure case that if he could force a mediation, force a situation where Mr. Cookies had to sit down and talk to me. In reading through the notes of Mr. Cookies' file, I had seen that this note and mortgage had been sold 5 or 6 times and transferred servicing 5 or 6 times as well. When I finally sat down, I saw in the notes that Mr. Harold knew real estate. He was a housing contractor. He had become disabled, had to draw this mortgage as a safety net to pay bills, consolidate debts after his injury, and to help him sustain. And now all of a sudden, the money that he had pulled out on this house was greater in number than the value of the house. That, combined with some bad servicing done by my predecessors, Harold had become very, very frustrated with the situation. So when he defaulted after 2009, stopped making payments, he tried to get a modification. He'd go to the servicer, they'd start working something out. But what you'll find is that most mortgage servicers and debt collectors are very disorganized institutions. So even if he would make progress trying to get a loan modification, then in his case, The loan was then sold to another institution, and so on and so on. He'd have to start over and over again. So by the time I met Harold, he did not believe there was a resolution. He had hired attorneys, filed bankruptcies, was doing whatever he could to save his house and to get the attention of the bank, with the hope that maybe somebody could come up with a solution. But by the time I met Harold, he didn't believe a solution was possible. We sat down in this forced mediation one Tuesday, and I remember he wouldn't even shake my hand at the beginning. He came in and he said, "I don't know what this is for. It's a complete waste of time. I've told the story, read the servicing notes. I've talked to the servicer. You guys don't have the right figures, and you're unwilling to help me. We're just going to wait here. We're going to sit here and waste our time." I took it upon myself to really appreciate his situation. As I got into the conversation, I knew everything about his file. His frustration with previous servicers not knowing his story and the fact that he had to repeat it so often was all of a sudden thwarted when I told him and explicitly that I knew the entire story back and forth. And I was here to try to come up with a resolution that works for us. There was a lot of anger, a lot of disbelief that what I was saying was true, that I, sitting here, had the power as the asset manager for this fund to make decisions that could affect this in a positive way. We spent several hours going back and forth in this mediation. I'll cut to the chase. Mr. Cookies owed us about $600,000 on this house. That included all the back fees and stuff from when he wasn't making payments. The value of the house itself, this gorgeous little 3-bedroom house just 2 blocks from the Intercoastal, a couple miles from downtown, where Mr. Cookies really had intended to spend the rest of his life in this historic house. Now he owed $150,000 more than the value of that house. Well, because I have access through my secondary market connections to buy this debt at its true collateral value net presently, I was obviously able to pay a lot less than $600,000 for that note. So we worked it out with Mr. Cookies. And 6 hours later, 6 into that mediation, we had come up with a $445,000 mortgage that if he made 6 months of trial payments and a small down payment to repay some back taxes that were owed, that we would be putting him into a permanent modification at a 5% interest rate, lower than I can even get on my home today, and back in a situation where he was no longer facing foreclosure, starting to build equity in his dream home again. And by the end of that 6 hours, Harold Cookies was not only shaking my hand, but he was smiling and thanking me for my persistence. This is a very happy story for me. It's a true win-win, and it's an example of the kind of stuff that we've done. I outline it in my book, Win-Win Revolution. I'm going to talk about it more in future episodes, and we're going to try to give examples either in the NPL market or in other businesses of people who are making a difference in our society by going out and finding ways to work in conflict situations, but to find a win-win resolution to those situations. That's it for this week, or this episode. As mentioned, we've got some exciting interviews ahead, great topics to cover. Hopefully I didn't take too long today. My name is Bill Bymel. Please subscribe to Win-Win Investor. Click subscribe, and thank you for watching Win-Win Investor.